Welcome everyone to another vital installment of Updates with John. Today, we delve into a financial paradox that is not only perplexing, but I believe deliberately obscured: the glaring disparity between the price of silver displayed on your screens and its true value in the physical market. This isn't an accidental miscalculation, it's a systemic divergence, a consequence of a financial architecture designed to price paper, not actual metal. This chasm between the theoretical and the tangible has become one of the most significant, yet willfully ignored, narratives in global finance today. As of this week, the COMEX spot price for silver hovers between $57 and $62 per ounce. This figure has been driven lower by a robust dollar, the Federal Reserve's increasingly hawkish stance under its new leadership, and the predictable algorithmic selling that invariably follows when key price thresholds are breached. Observing this number alone, one might conclude that silver is in retreat, that its utility in the world is diminishing, and that the bearish predictions are proving correct. However, this perspective dramatically shifts when we turn our gaze eastward, specifically to Shanghai. On the Shanghai Gold Exchange, physical silver is currently trading at a premium exceeding 10% above the Western spot price. Shanghai silver is quoted around $62.55 per ounce, while the Western spot price lingers near $56.51. This isn't a minor fluctuation or a transient anomaly that will self-correct within hours. This premium exists for a fundamental reason. When physical demand in Asia surges, while COMEX remains dominated by paper-based trading, the Shanghai premium expands. This expansion serves as an undeniable signal that the physical market is considerably tighter than what futures prices suggest. One market proclaims silver is inexpensive. The other, where buyers actually take physical possession of the metal, communicates a profoundly different message. It asserts that silver is scarce. It indicates that demand is outstripping supply. It reveals that somewhere, someone is actively bidding up the price of actual deliverable silver, even as the headline number on your screen continues its downward drift. One of these two markets is fundamentally mistaken. By the conclusion of our discussion today, you will possess a precise understanding of which one is erroneous, and more importantly, why. Let us commence with the foundational understanding, for intellectual rigor demands we comprehend the nature of these two markets before attempting to interpret their signals. COMEX, the commodity exchange based in New York and a division of the CME Group, is widely recognized as the institution that establishes the global benchmark price for silver. When your local coin dealer provides a quote, it is derived from COMEX. When a mining corporation seeks to hedge its future production, it does so against COMEX prices. This number is ubiquitous and carries immense weight. But what precisely is COMEX actually trading? COMEX primarily functions as a derivatives marketplace. A staggering reality is that fewer than 1% of silver futures contracts traded on COMEX ever culminate in physical delivery. The vast majority are either cash settled, rolled over into subsequent contracts, or closed out before any actual metal changes hands. In its essence, COMEX is a market for paper promises. It prices the abstract concept of silver. It prices the financial instruments that represent silver, and this price is predominantly determined by the powerful institutions that dominate its trading landscape: the colossal commercial banks, the agile hedge funds, and the sophisticated algorithmic systems. These systems do not respond to the fundamental dynamics of physical supply and demand. Rather, they react to moving averages, momentum indicators, and the strategic positioning of other major players. The price on COMEX is a reflection of financial maneuvering, not necessarily the underlying physical reality. In stark contrast, the Shanghai Gold Exchange, SGE, operates on an entirely distinct philosophical principle. The SGE mandates physical delivery. When traders acquire silver contracts on this exchange, they are entitled to, and typically receive, actual metal. This means that SGE prices are a direct and unadulterated reflection of the supply and demand for real deliverable silver. These are not mere promises of silver, they are silver itself. The buyers on the Shanghai Exchange are predominantly industrial fabricators, electronics manufacturers, and producers of solar panels, entities that require physical delivery because they have factories to operate and products to ship. When these entities pay a premium, they are not engaging in speculative wagers. They are paying the price that the physical market demands of them. They are expressing, through actual capital, their assessment of silver's true worth in a world characterized by constrained supply and accelerating industrial demand. Now, let us consider the developments over the past several months. The SGE's silver benchmark has consistently traded at premiums ranging from 16% to 18% above the COMEX spot price. At various junctures earlier this year, the SGE spot silver contract settled at approximately $78.55 per ounce, a figure substantially higher than the global COMEX benchmark. This premium, when quantified in dollar terms, has reached levels far beyond what could be reasonably explained by typical factors such as transportation costs, currency conversion fees, import duties, or financing charges. This is not merely normal market friction. This is the physical market unequivocally signalling distress, and it is being systematically disregarded by the majority of Western financial commentary. These commentators continue to report the COMEX number as if it were the complete and accurate representation of silver's global value, when in reality it is merely one data point from one specific type of market driven by a very particular set of incentives. The question then arises, why does this divergence persist? Why doesn't the fundamental principle of arbitrage, buying cheap on COMEX and selling dear in Shanghai, effectively close this gap? The answer illuminates a crucial aspect of the architecture governing global commodity markets. China's import quotas, meticulously controlled by the People's Bank of China, inherently restrict the supply of silver entering the country. Simultaneously, robust domestic demand exerts upward pressure on the Shanghai benchmark price. Furthermore, stringent capital controls on the yuan limit cross-border arbitrage opportunities, thereby allowing the significant spread between the SGE and Western spot prices to endure. Moreover, the logistical complexities of physically transporting silver from an American vault to a Chinese industrial buyer are considerable, involving licensing, insurance, customs clearance, and weeks of transit. By the time the metal eventually arrives, the premium could have shifted. While arbitrage theoretically exists, in practice it operates slowly, incompletely, and is subject to the inherent friction of a world where capital and physical metal do not flow freely across international borders on demand. This friction itself is highly revealing. The premium persists not because it has gone unnoticed, but because the structural constraints preventing its closure are real, enduring, and deeply embedded within the geopolitical framework of global trade. China maintains sovereign control over its import channels, dictating what enters the country, in what quantities, and at what times. And what is currently flowing into China, in volumes that should command far greater attention than they presently receive, is silver. China's silver imports reached an astonishing 206.76 tonnes in the first 2 months of 2026 alone, marking the highest level in 8 years. This metal is not simply disappearing. It is being channeled into factories, integrated into solar panels, and assimilated into the circulatory system of the world's largest manufacturing economy. And it is being acquired at prices substantially above what the COMEX chart suggests silver is worth. The COMEX chart is not intentionally deceptive, it is structurally misleading. Understanding this underlying structure is the entire crux of our discussion today. If the initial part of this narrative focuses on the quantitative gap between two prices, the subsequent part elucidates the reasons for its existence. The answer begins not within the bustling trading floors of New York or the secure vaults of London, but amidst the vast, sun-drenched industrial landscapes of eastern China. Here, the most profound transformation in global energy infrastructure in a generation is unfolding, consuming silver at a rate that the supply side of this market has been structurally incapable of matching for 6 consecutive years. China is responsible for manufacturing approximately 80% of the world's solar panels. Each panel incorporates roughly 10 to 20 grams of silver, depending on the specific cell technology employed, whether it be PERC, TOPCon, or the more advanced HJT architecture. Silver is indispensable in this application, deposited as a conductive paste within photovoltaic cells due to its unparalleled electrical conductivity. It is the most electrically conductive metal on Earth. Despite decades of research and development, the solar industry has yet to discover a commercially viable alternative that performs with comparable effectiveness. Silver is not merely beneficial in solar panel manufacturing, it is, in a precise and irreplaceable sense, absolutely necessary. China's rate of solar capacity installation is staggering, driven by a national energy policy that is immune to the quarterly earnings pressures or political volatility that often characterize energy investment in Western nations. Furthermore, consider the immense scale of China's broader industrial footprint. The country serves as the world's manufacturing hub for electronics, electric vehicles, 5G telecommunications infrastructure, and the advanced military applications that, while rarely discussed publicly, are consistently funded by every government. Silver is an integral component in all these sectors. It is embedded within every circuit board, every battery management system, every radar array, and every piece of communications hardware that facilitates the global exchange of digital information. China produces an extraordinary proportion of these goods, and their production necessitates silver. This continuous demand for silver, in quantities that the global market, already operating under a structural deficit, struggles to provide, inevitably leads to a bidding up of the price of physical silver in Shanghai, pushing it above what COMEX suggests it should cost. This brings us to a central data point that every serious observer of this market should commit to memory. The global silver market is currently experiencing its sixth consecutive year of supply deficit. The Silver Institute projects a shortfall of 46.3 million ounces in 2026, an increase from the 40.3 million ounces recorded in 2025. A deficit, in its simplest terms, signifies that the world is consuming more silver than it is producing from mines and through recycling efforts. This means that each year, the gap between what industry and investors demand and what the Earth yields must be filled from alternative sources. For the past 6 years, these alternative sources have been above-ground stockpiles, metal stored in exchange vaults, in dealer inventories, and within exchange-traded funds. These stockpiles, accumulated over decades of surplus production, are now being steadily depleted to bridge the supply-demand imbalance. Since 2021, these stockpiles have been drawn down by an estimated 762 million troy ounces, according to the Silver Institute. I urge you to reread that number slowly. 762 million ounces. This is not a minor statistical footnote. This represents an enormous, irreversible transfer of above-ground silver from storage into active consumption, from secure vaults to bustling factory floors, from a financial instrument that could theoretically be resold into the market to a physical product that has been permanently consumed and cannot be recovered without an entirely different and significantly more expensive industrial process. And what has been the fate of the vaults that are supposed to underpin the paper contracts traded on COMEX? Registered silver inventories at COMEX, specifically the metal eligible for delivery against futures contracts, stood at approximately 79.9 million ounces in mid-May 2026, representing a decline of more than 75% from their 2020 highs. In February 2026, the total registered silver at COMEX fell below the closely watched 100 million ounce threshold, with a single-day negative adjustment of over 3 million ounces from the registered category, accompanied by withdrawals exceeding 4.7 million ounces from the eligible category within the same 24-hour period. These are not gradual, barely perceptible shifts. These are substantial, rapid and directional movements of physical metal out of the very vaults that lend credibility to the paper market. Now I ask you to hold both of these critical facts in your mind simultaneously. The paper price of silver is declining, influenced by dollar strength, the Federal Reserve's hawkish stance, and algorithmic momentum selling on COMEX. Concurrently, the physical silver that underpins this paper market is being withdrawn from vaults at historically unprecedented rates. In most commodity markets, a decline in inventory typically drives prices higher, as tighter supply commands higher prices when demand is stable. What we are witnessing, however, is the inverse. Downward price pressure emanates from paper markets, which operate on a distinct set of incentives, while the physical infrastructure of those very same markets is quietly being hollowed out. This is precisely the juncture where I need to address you directly. If you have been observing silver, if you have been accumulating physical metal, if you have been questioning whether the data you are encountering truly signifies what it appears to signify, then I implore you to subscribe to the OG John AG right now. Do this before the next video is released, before the next critical data point emerges, before the moment arrives when this story becomes unequivocally obvious to the broader public, rather than remaining visible only to those who are paying meticulous attention. The moment it becomes obvious is the moment it becomes prohibitively expensive. Subscribe. Hit the bell notification. What I am endeavouring to build here is a comprehensive library of analysis, specifically designed for individuals who aspire to comprehend these markets before the masses do, not merely in their aftermath. Let us return to the mechanics. Why can the paper price decline while the physical market experiences such acute tightening? The answer lies in the identity of those who control COMEX price action and their inherent incentives. The dominant institutional forces on the short side of COMEX silver, primarily the commercial banks and trading houses categorized by the Commodity Futures Trading Commission, CFTC, as commercial entities in their weekly Commitments of Traders report, are not primarily expressing a view on silver's fundamental value. Instead, they are managing hedges, executing sophisticated trading strategies, and, in many instances, profiting from a cyclical pattern that recurs with remarkable regularity. This pattern involves pushing the price through a key technical level, thereby triggering algorithmic selling by momentum-following managed money accounts, observing the price cascade lower, and then covering their short positions at these reduced prices to secure a round-trip profit. This is not a mere theoretical construct. It is demonstrably evident in the CFTC data week after week. During periods of sell-off, managed money net long positions collapse, while commercial short positions shrink simultaneously. The commercials are effectively buying back what they sold at higher prices. The price movement, therefore, is not a reflection of silver becoming less valuable to the factories of Shenzhen or the solar farms of Xinjiang, but rather a consequence of how a leveraged paper market functions when large, sophisticated institutions engage with the patience and capital necessary to dictate the terms. The Shanghai premium serves as the physical market's direct response to this dynamic. China's industrial buyers cannot utilize a futures contract in their manufacturing processes. They cannot electronically transfer a paper position to a solar panel manufacturer. When physical demand surges in Asia, while COMEX remains driven by paper selling, the Shanghai premium widens, signalling that the physical market is considerably tighter than futures prices suggest. And this widening has persisted for months. That persistence is the crucial signal. An anomaly that corrects within hours is mere noise. An anomaly that endures across weeks and months represents a fundamental structural shift, and it is within this structure that the true narrative resides. We have established the gap. We have elucidated its underlying causes. Now, let us discuss its implications, for the most pertinent question in any market analysis is not what has transpired, but what is likely to occur next when the forces currently in motion reach their logical culmination. What distinguishes the current COMEX inventory drawdown from previous episodes is its unprecedented persistence. Prior inventory declines, observed in 2011, 2015, and during the 2020 pandemic, typically reversed when prices rebounded or when physical demand eased. This time, however, the decline has continued unabated through multiple years and diverse market conditions, with no reversal in sight. 6 consecutive years of deficit, 6 years of above-ground stock drawdowns, a structural imbalance between an inelastic supply and deeply entrenched industrial demand that has remained unresolved even by the dramatic price spike in January 2026, when silver briefly traded above $121 per ounce before a violent correction triggered by CME margin hikes and the liquidation of leveraged long positions. The crisis conditions of early 2026, which included a single week in January where COMEX registered inventory experienced a withdrawal of 33.45 million ounces, and the London silver lease rate surged to 30%, a level not witnessed since the infamous Hunt Brothers episode of 1980, demonstrated that when acute physical tightness converges with aggressive speculative positioning, the system can fracture with extraordinary speed. Unlike previous silver price surges, which were primarily fueled by monetary demand or speculative attempts to corner the market, the 2026 event was firmly rooted in genuine industrial consumption that cannot be easily or quickly substituted. This distinction is what separates the current situation from prior periods of silver excitement. The Hunt brothers, for instance, attempted to corner the silver market in 1980 through speculative accumulation. However, the current demand is driven by fundamental industrial requirements, making it a far more robust and enduring factor. The implications of this sustained physical demand, coupled with dwindling inventories and a paper market that appears increasingly disconnected from reality, are profound. The long-term trajectory for silver, despite short-term volatility, appears increasingly bullish. The market is slowly but surely being forced to acknowledge the underlying physical scarcity. As the gap between paper prices and physical reality continues to widen, and as industrial demand continues to outstrip supply, a significant repricing of silver appears inevitable. The question is not if, but when the paper market will finally capitulate to the undeniable forces of physical supply and demand. Until then, stay informed, stay vigilant, and remember that understanding these deeper currents is paramount to navigating the complexities of the silver market. This is John, signing off for Updates with John.